Welcome to the Deep Dives look into the Talk Tickers universe. You're tuning in because you want the unvarnished truth behind the numbers. And today, we're tearing into a really fascinating Q4 2025 earnings call from a company that, practically defined the pandemic-era crafting boom.
Yeah, Cricut.
Exactly, Cricut. Today is March 4, 2026, and we're unpacking the results that just hit the tape yesterday, right after the closing bell. Now, if you were watching the after-hours action, you saw the initial market reaction. Shares popped almost 5% to around $4.52 on slightly elevated volume.
Right.
So on the surface, if you're just glancing at your portfolio app, it looks like a sigh of relief from the market.
It does look like a sigh of relief on a 5-minute chart. But we have to immediately temper that enthusiasm and zoom out to the actual structural reality of this equity. Yes, a nearly 5% bump in after-hours trading feels like a win if you happen to be holding the stock today. But let's put that into the broader context of the market environment.
Yeah, let's zoom out.
Over the last 3 months, the stock has been severely bruised. It is down nearly 13%. If you look over the trailing 12 months, the last year, it's down 17%. And that is severely lagging the broader consumer discretionary sector.
Let's actually pause and define that for a second, because context is everything here. When we talk about the broader consumer discretionary sector, we're usually benchmarking against something like the XLY.
Right, the ETF.
Yeah, for anyone not staring at ticker symbols all day, the XLY is an exchange-traded fund, an ETF that tracks companies selling non-essential goods and services. We're talking about everything from home improvement stores to automakers to luxury retail. It's a great barometer for whether everyday people feel wealthy enough to spend money on their hobbies and desires rather than just their basic needs.
That is a crucial distinction. The consumer discretionary sector is essentially the fun money index. And if you benchmark Cricut against that XLY ETF, the XLY is actually up nearly 8% over the last 52 weeks. So you have a situation where consumers are, broadly speaking, still spending some of their discretionary income, but they're increasingly choosing not to spend it on Cricut's ecosystem. You have a company vastly underperforming its peers in a macroeconomic environment that is challenging, yes, but not apocalyptic for retail.
And that brings us to the core mission of our analysis today. We are not just going to read you the top and bottom lines and call it a day. We're treating this deep dive as a forensic investigation into a company experiencing a massive fundamental identity crisis.
Identity crisis is the perfect way to phrase it.
Right. What we have here, hidden beneath the surface, is a highly profitable, incredibly sticky software engine. But that beautiful software business is essentially trapped inside a struggling, low-margin hardware and materials business. It's a tale of two entirely different business models operating under one single ticker symbol.
It's the ultimate corporate Dr. Jekyll and Mr. Hyde. You have a sleek, modern software-as-a-service platform fighting against a clunky, commoditized consumer hardware anchor. And to understand how that tension played out during the critical holiday season in the fourth quarter, we need to rip into the headline numbers. They paint a very contradictory picture of where this company is actually heading.
Let's pull up that results snapshot and look at the headline numbers versus Wall Street's expectations.
Yeah.
On the bottom line, Q4 GAAP earnings per share, that's generally accepted accounting principles, basically the standardized way of measuring pure profit divided by the number of shares, came in at 0.04 cents.
Right.
In real dollars, that translates to $7.8 million in net income for the quarter. That beat the Street's 0.03 consensus by a penny. Now, a penny might not sound like much to you, but mathematically, that is a solid 33% beat on the bottom line.
Yep.
Then we look at the top line. Revenue for the quarter came in at $203.6 million, which also slightly edged out the $202.47 million consensus that analysts had modeled. But this is where I think the red flashing lights start going off.
Oh, absolutely.
That revenue figure, despite the slight beat against lowered expectations, is actually down 3% year over year.
That 3% year-over-year decline is the glaring neon warning sign that you simply cannot ignore. I mean, it is entirely possible for a management team to engineer an earnings per share beat. You can aggressively cut costs, you can slash marketing budgets, you can lay off staff.
Or benefit from a favorable shift in your margin mix.
Exactly. But a shrinking top line, shrinking overall sales in the fourth quarter, which is the paramount holiday gifting season for a consumer hardware company, is a fundamental structural issue. You cannot cost cut your way to long-term growth.
That's the golden rule of retail, isn't it? You can squeeze the sponge to get more profit out of it for a few quarters, but eventually you need a bigger sponge. And if we zoom out to the full year 2025, the story is incredibly consistent with that Q4 dynamic. Full year revenue was $708.8 million. That is down less than 1% year over year.
Basically flat.
Yeah, flat to very slightly negative. Yet full year net income jumped a massive 22% to $76.7 million. They expanded their net profit margin to 10.8%.
Which is an impressive feat of operational efficiency on the surface, but it forces anyone analyzing this equity to ask a very difficult question. How does a company operating in the consumer discretionary space manage to grow its profits by 22% while its actual revenue is shrinking?
It completely defies traditional retail logic.
It does. Usually, retail relies on what we call operating leverage. The idea that once you cover your fixed costs, like your warehouses and your corporate headquarters, every additional dollar of top-line sales drops straight to the bottom line. Here, the top line is vanishing, but the bottom line is swelling.
I think we have to spend some time unpacking that because it is the entire key to the Cricut thesis. It makes perfect sense when you realize the revenue mix is shifting dramatically.
Yeah.
They're essentially selling fewer physical things, but the things they are selling, or rather the services they are providing, are incredibly lucrative. And this brings us directly into the first major breakdown of our deep dive, the two-speed business model. The profit growth is entirely 100% driven by what we can call their powerhouse platform segment. Let's look at those Q4 platform revenue numbers. They brought in $83.9 million from the platform alone. That is up 6% year over year.
And that platform revenue isn't just one-off software sales. It is recurring subscription revenue, which is the holy grail for any business. They now have 3.091 million paid subscribers. That is an increase of over 4% from the previous year. They added 132,000 paid subscribers year over year.
That's huge.
Think about that from a behavioral standpoint. 3 million people are paying a monthly or annual fee just for the privilege of accessing digital designs, fonts, and enhanced software features to use with a machine they already bought.
Right. And it's not just the sheer volume of users, it's how efficiently they are monetizing that specific cohort. Let's look at the average revenue per user, a metric you'll often hear referred to as ARPU. It's exactly what it sounds like. How much cash they extract from the average subscriber over a given period.
And where is that sitting right now?
Their ARPU is sitting at $55.77 on a trailing 12-month basis. That metric is up 5%. So they're not only growing the absolute number of people in the tent, but they're also getting everyone inside the tent to spend slightly more money.
That ARPU growth is impressive, especially in an inflationary environment where consumers are scrutinizing every single monthly subscription on their credit card statements. But here is the data point that should make any software investor sit up and pay very close attention. The gross margin on this platform segment is staggering.
Yeah, let's get into the margins.
We are talking about an 88.6% gross margin in Q4. That is actually up from 87.9% in the same quarter last year. If you look at the full year of 2025, it hit 89%.
Let's break down what an 89% gross margin actually means in the real world, because it is almost unfathomable if you're used to looking at manufacturing companies. It means that for every $100 a subscriber pays Cricut for digital access, it only costs Cricut $11 to deliver that service. The other $89 is pure gross profit before operating expenses.
Pure profit engine.
Exactly. Management noted on the call that this specific expansion was largely due to lower amortization of software development costs, meaning they've already paid for the bulk of the heavy coding and infrastructure, and now they are just reaping the recurring rewards.
I cannot emphasize this enough. An 89% gross margin is top-tier software as a service territory. We are talking about an Adobe-level margin profile, a Microsoft-level margin profile, and it is sitting right there, hidden in plain sight, inside a company that the broader market largely writes off as a niche crafting and scrapbooking hardware manufacturer. If Cricut were a pure-play software company with 3 million subscribers and 89% margins, it would be trading at a massive valuation premium.
That software margin is a beautiful, beautiful thing. But unfortunately, every superhero has an origin story that involves some tragedy, and we have to look at the other side of the ledger. We have to look at the hardware materials drag. Let's look at the products segment. Q4 revenue for physical products was $119.7 million. That is down 8% year over year.
Yeah.
If we slice that pie further, the connected machines themselves, the actual mechanical cutters like the Maker or the Explorer, fell 4%.
And the management team's reasoning for that 4% drop in machine revenue is incredibly telling. They cited aggressive promotional pricing. In plain English, they had to slash the price tags.
Fire sale.
Pretty much. They had to lower their average selling prices, or ASPs, to convince consumers to buy the inventory they had sitting in warehouses, particularly ahead of a slew of new product launches they have planned. When you have to discount your core product heavily during the biggest shopping season of the year just to move units, it tells you that organic demand is incredibly soft.
It's the classic retail trap. But as bad as the machine sales were, the really brutal number, the one that made me physically wince when I read the release, is accessories and materials. That category took a massive 13% hit in the quarter. It dragged the full-year materials number down 9%. Let's talk about the history of this business model to understand why that 13% drop is so devastating.
It is devastating because it attacks the foundational premise of their historical business model. For decades, consumer hardware companies have relied on the razor and blade model. Gillette practically invented it. You sell the razor handle at a loss, or at breaks even, because you know the customer is locked in and has to buy your high-margin replacement blades for the rest of their life.
The video game industry does the same thing with consoles and games. Keurig does it with coffee makers and pods.
That is a perfect comparison. Cricut's model was supposed to be sell the crafter a $300 cutting machine and then enjoy years of them coming back to buy your branded vinyl, your branded transfer tape, your specialized cutting mats, and your replacement blades.
But that model is fracturing. The gross margin for the product segment in Q4 was just 18.4%. Compare that to the 89% we just talked about for software. 18.4% is barely enough to keep the lights on after you pay for shipping, warehousing, and retail shelf space.
And it is fracturing because of immense, relentless competitive pressures. To his credit, the CEO was surprisingly candid about this on the call. He didn't try to hide behind macroeconomic excuses. He admitted that there is an incredibly low barrier to entry for white label materials.
Right. Think about the user journey for a second. You're a hobbyist. You just spent $300 on a machine. You want to make custom t-shirts for your kid's soccer team. You go to buy heat transfer vinyl. If you buy the official Cricut brand, maybe it costs you $15 for a small roll. But you go onto any massive online marketplace, we all know the one, and you search for craft vinyl.
And you're flooded.
You are instantly flooded with hundreds of options from brands you have never heard of, offering a 50-foot roll for $12. And the truth is, a lot of those off-brand materials work just fine. The machine doesn't care whose vinyl it is cutting.
That is the crux of the problem. The economic moat around their proprietary consumable materials is evaporating in real time. A moat, in investing terms, is a company's ability to maintain a competitive advantage and protect its long-term profits from competitors. Cricut's moat used to be the convenience and guaranteed quality of their own materials.
But consumers have gotten smarter.
Consumers have gotten smarter, and the white label quality has gotten better. Consumers are perfectly happy to buy the hardware, plug it in, and then completely bypass the Cricut retail ecosystem for cheaper materials.
Which explains exactly why the hardware business is acting as an albatross around the neck of this incredibly profitable software platform. But before we get too depressed about the death of the razor and blade model, we should inject a little optimism here and point to the international bright spots. The world outside of North America seems to be adopting the ecosystem at a healthy clip.
Yeah, international is a different story.
International sales actually hit $57.8 million in Q4, which is a 9% increase. International now makes up 28% of their total revenue, up from 25% a year ago.
That geographic diversification is a crucial lifeline for the executive team right now. If your domestic market is saturated and facing massive white label competition, you have to find new demographics. If we look at the specific regions driving this international growth, Australia is a great case study.
What happened in Australia?
The Australian market had been really struggling for them, but it has finally stabilized. They implemented enhanced pricing and localized marketing programs in the second half of the year that seem to have stopped the bleeding.
It shows that targeted, region-specific management can actually move the needle. And then you have Europe, which is showing solid growth, driven primarily by an expansion of their physical store presence ahead of the peak holiday season. They are getting the machines onto physical shelves where people can see them. But what's really intriguing to me is the traction in emerging markets. Places like Japan and India are starting to fire up.
Those emerging markets represent massive, largely untapped, total addressable markets. The crafting culture in Japan, for instance, is massive and highly detail-oriented, which perfectly aligns with a precision cutting machine. If they can successfully localize the software and the design library for the Japanese and Indian markets, the runway for subscriber acquisition there is enormous.
We should definitely note, though, to keep our analysis grounded, that foreign exchange rates provided a significant 6% tailwind to those international sales in Q4 and a 4% tailwind for the full year. So if you strip out the benefit of the weak U.S. dollar making international sales look better when translated back, the constant currency growth is a bit more muted.
Right.
It's still growing, but the currency fluctuations did them a massive favor this quarter.
That is a very important technical caveat. The international expansion is undoubtedly buying them time. It's keeping the top line from collapsing entirely. But the critical question is, time to do what? How are they going to fix the core problem?
And that leads us directly into the strategic pivots and the management insights we gleaned from this call. Because make no mistake, management is acutely aware of the eroding moat in the materials business. They see the Amazon search results just like we do. And in response, they're initiating a massive fundamental strategic shift. Moving forward, they are prioritizing what they're officially calling a bundle-first strategy.
Yes, let's dive deep into this because this is a massive operational pivot that will change how consumers interact with the brand. They announced that going forward, they will only sell their next-generation machines bundled with tools and materials. You won't be able to just buy a naked cutting machine anymore.
They're framing this from a PR perspective as an out-of-the-box experience play.
How exactly did they pitch that user experience angle on the call?
Well, think about the universal frustration of being a kid on Christmas morning. You tear open the wrapping paper, you get the remote control car you've been begging for all year, and then you see those soul-crushing words on the box. Batteries not included.
Worse.
The toy is useless. You are instantly frustrated. Cricut is arguing that the same thing happens to new crafters. They buy a bare machine, they take it out of the box, and they realize they don't have the right mat, or they don't have transfer tape, or they don't have a weeding tool to peel the vinyl.
So they're stuck.
Exactly. So the idea is to reduce friction for new users, give them a curated box with absolutely everything they need to complete their very first guided project the minute they open it. The goal is to prevent them from getting frustrated, putting the machine in the closet, and abandoning the ecosystem before they even start.
That is the marketing spin, and frankly, it is a perfectly valid user experience argument. Friction is the enemy of software adoption. But as analysts, we have to read between the lines. This is a highly defensive, margin-protecting strategy disguised as a customer service initiative. This is a direct, undeniable response to that massive 13% drop in accessories and materials we discussed earlier.
You think it's entirely about trapping the consumer?
I wouldn't use the word trapping, but it is certainly about funnel control. By forcing the bundle, they are guaranteeing that the very first physical materials a new user touches, feels, and cuts are proprietary, high-margin, Cricut-branded materials. They're desperately trying to prevent the scenario where a consumer buys a bare-bones machine on a Black Friday promotion, goes straight to a cheap knockoff brand for their vinyl, and never, ever enters the Cricut materials funnel.
They want to set the baseline of quality with their own products, hoping the user becomes brand loyal.
Exactly.
That makes total strategic sense. If you know the razor and blade model is dying, you force them to buy a lifetime supply of blades on day one. But here is a crucial note for you as an investor trying to model this out moving forward. Because of this bundle-first shift, management announced a major change to their accounting.
And this is where it gets tricky.
Yeah. They will no longer break down connected machines versus accessories and materials revenue in their SEC filings. Moving forward, both of those categories will just be smashed together and reported as total product revenue.
And I can tell you right now, Wall Street absolutely hates losing visibility. It is one of the cardinal sins of investor relations. When a management team stops breaking out specific, granular metrics that they have historically provided, the immediate cynical assumption from analysts is always that they are trying to hide deterioration.
It's the classic, if the numbers were good, you'd be shouting them from the rooftops mentality.
Precisely.
Management claims this consolidated reporting simply reflects how the business will actually be run and managed internally going forward. Since the machine and the materials are in the same box, they argue it doesn't make accounting sense to arbitrarily split the revenue. And legally, under SEC rules, companies are only required to report on their operating segments as they are managed by the chief operating decision maker.
Legally, they are perfectly within their rights. But make no mistake, losing that specific line item is going to severely frustrate analysts. It means it will be vastly more difficult for us to track if the standalone materials business continues to bleed market share to white label competitors.
Because we just won't have the numbers.
Exactly. If product revenue goes down next year, we won't mathematically know if it's because people start buying machines or they just stop buying replacement vinyl. It completely obscures the unit economics of the hardware division.
It definitely throws a blanket over the data. But let's look at what that hardware actually is, because we did get a very clear, transparent view of the product roadmap and the massive injection of AI into the ecosystem. They are not sitting still on the engineering front.
No, they've been busy.
For 2026, they've already launched a slew of new hardware. You have the Cricut Joy 2, which is their small, entry-level, highly portable machine. You have the Explore 5, which is their mid-tier bread-and-butter cutter. And they also launched the new EasyPress SE and the Mini LT heat presses, which are used to actually iron the vinyl onto the t-shirts or bags.
A major takeaway from this product slate, which connects back to everything we've discussed about pricing pressure, is that these new cutting machines have significantly lower introductory price points than the machines they launched last year. The Joy 2 is cheaper than the original Joy was at launch.
Which is great for the consumer, but a headache for the CFO.
A massive headache. It is going to create a very difficult revenue comparable in the first half of 2026. If your average selling price is lower, you have to move significantly more physical volume just to keep your top-line revenue flat year over year. You have to sell 3 machines to make the same revenue you used to make selling 2.
But the hardware, as we are establishing, is really just the Trojan horse for the software roadmap. The machines are just the gateway drug to get you paying that $55 a year. And the software side is where things get genuinely futuristic. They are rolling out what they call project-guided flows.
Which ties into the bundles?
Yes, this ties directly into the bundle strategy we just discussed. The software now literally holds your hand step by step from the moment you take the machine out of the box, telling you exactly which mat to use, which blade to insert, and what button to push. But the real buzzword of the quarter, the thing that had analysts perking up, is create AI.
And we have to be careful here because every company on earth is slapping AI onto their earnings transcripts right now to try and get a multiple bump. But in Cricut's case, it actually has a very specific, highly utilitarian application.
Right. Create AI is basically their generative text-to-image feature built natively into the design space. Let's say you're making a birthday banner for a kid who loves pirate ships and dinosaurs. If you can't find the exact graphic of a T-Rex wearing an eye patch in the existing Cricut library, you don't have to go buy a file on Etsy anymore.
You just prompt it.
You just type in a prompt, T-Rex wearing a pirate hat. It generates an image, and the software automatically vectorizes it. It formats the lines so the physical blade can actually cut it out without shredding the paper. They're explicitly using this as a subscriber acquisition tool. You want the AI, you have to push the button and upgrade to the paid tier.
It is a phenomenal top-of-funnel acquisition tool. It directly solves a pain point for users who aren't naturally gifted graphic designers. However, the chief financial officer issued a very specific warning on the call that we need to pay close attention to.
Which was?
Generative AI is not cheap. Scaling these text-to-image features requires significant cloud compute power. Every time a user hits generate, Cricut pays a server toll. The CFO warned that as AI adoption ramps up among the user base, those compute costs might begin to pressure those beautiful 89% platform margins we were just praising.
So the very tool they are using to get people into the software might actually erode the profitability of the software itself.
That is the risk. It's a necessary evil, though. They have to invest in these engagement tools because of a very concerning underlying metric. Their 90-day active user metric, which measures the people who are actually plugging in and using the machines, not just paying for the subscription and forgetting about it, declined 3% year over year.
Ouch.
Total active users were essentially flat at 5.9 million. So they are retaining the overall base. People aren't throwing the machines in the garbage, but the frequency of use is slipping. AI is their primary lever to reignite that inspiration, to get people cutting more often, because if they stop cutting, eventually they will cancel the subscription.
But what if they don't want to use a cutting machine at all? What if the future of Cricut isn't a blade cutting vinyl on a desk? The company has a brand new wild card up its sleeve, and I think this might be the most important part of the entire call.
It's definitely the most forward-looking.
It's called direct-to-film, or DTF. They soft-launched this service in Q1. Why does this matter to you as an investor? Because it represents a complete paradigm shift for the company.
Let's explain what DTF actually is, because it sounds like manufacturing jargon.
It is, but the application is beautifully simple. DTF allows users to create incredibly complex, full-color, personalized artwork inside the Cricut software. But instead of the user having to print it out on a special printer and cut it with a blade, Cricut does the work.
The heavy lifting.
Exactly. The user clicks a button, and Cricut prints the design onto a special transfer film at their own massive commercial facility. They package it up, and they mail the physical film directly to the user's house. The user simply takes an iron or a heat press, presses the film onto a t-shirt or a tote bag, peels off the backing, and they have a professional, commercial-grade custom garment.
This is a massive, massive strategic pivot. Think about the implications. They are finally monetizing the software platform, the design space, and the guided flows without the user ever needing to own, maintain, or troubleshoot a cutting machine.
Right now, management noted the rollout is limited. It's only available on the desktop version of the software, and it's only shipping within North America. But we connect this to the bigger picture. This has the potential to completely detach their high-margin software and services revenue from the burden of hardware ownership.
It turns them from a hardware manufacturer into a true print-on-demand service provider, like a custom ink, but powered by millions of individual at-home creators.
Exactly. And if this scales, the total addressable market explodes. Suddenly, the barrier to entry is gone. You don't have to convince someone to spend $200 to $400 on a complicated machine that takes up half their desk. Anyone with a laptop and an iron can become a Cricut customer. It is the ultimate evolution of the software platform.
It's a fascinating prospect, and it paints a picture of what this company could be in 5 years. But Wall Street operates in quarters, not decades. Before we get too far into the futuristic print-on-demand vision, we have to look at the immediate reality of the guidance and capital allocation discussed on the call.
The bills still have to be paid today.
Right. Let's summarize the 2026 outlook provided by the CFO. On the bright side, they expect the company to remain profitable every single quarter in 2026. They expect to generate positive cash flow from operations for the full year, and they remain committed to entirely self-funding their growth investments, meaning they aren't going to go out and borrow expensive money to build out these AI or DTF projects.
That sounds incredibly stable, and in a volatile market, stability is a premium. But I have to issue a severe warning about the first half of 2026. If you are modeling this company, the financial comparables for Q1 and Q2 are going to look incredibly rocky before they hit their stride in the back half of the year.
And that's because of what happened last year.
Right, why is that? What happened last year that makes the comparison so difficult?
In Q2 of 2025, they experienced a massive artificial pull forward of materials demand. Consumers and retailers were essentially hoarding materials due to extreme uncertainty around import tariffs at the time. Everyone thought the price of vinyl was going to skyrocket by 30% overnight, so they bought 6 months' worth of supplies in a single quarter.
So they artificially inflated last year's numbers, and now they have to try and beat those inflated numbers this year with normal demand.
Precisely. They are lapping an artificially inflated quarter. Combine that tough comparable with the lower average selling prices of the new machines we discussed earlier, and the first half revenue and margin numbers could look quite ugly on a year-over-year basis. The market might panic when they see those Q2 numbers, but it's important to know the historical context behind them.
And on top of the financial metrics, they also warned about subscriber seasonality. Management explicitly stated that paid subscriber growth might be totally flat or even decline quarter over quarter in Q2 and Q3. Historically, the summer months are tough for crafting. People are outside, they're traveling, they aren't inside making personalized mugs.
Exactly.
So between the hardware comps and the stagnant subscriber growth, the summer months could severely test investor patience.
Which brings us to the macroeconomic elephant in the room, the geopolitical supply chain reality. Anyone who follows international trade knows about the recent Supreme Court ruling that overturned the AIPA tariffs.
Let's quickly define that for the listener. The AIPA tariffs were a broad set of import duties levied on certain manufactured goods coming from overseas. The Supreme Court recently struck them down, arguing the executive branch overstepped its authority in how they were applied.
Right.
On paper, for a company like Cricut that manufactures all of its hardware in Asia and imports it to the U.S., that ruling is a massive legal victory. It should theoretically relieve enormous cost pressures. Yet despite this seemingly positive development in the news cycle, management flat out refused to provide any gross margin guidance for the rest of the year.
I found that fascinating. The analysts pushed them on it, citing the Supreme Court victory. But management held firm, citing ongoing tariff uncertainty and associated dynamics. What does that actually mean? It means that legal rulings in the Supreme Court do not dictate executive branch trade policy in real time. We are operating in a highly volatile geopolitical climate. Trade wars are fought with executive orders, not just legislation.
So you're saying management doesn't trust the ruling to actually protect them?
Management is acutely aware that the executive branch could implement sweeping, broad-based tariffs on consumer electronics or raw materials manufactured overseas at a moment's notice. They could use a different legal justification, entirely bypassing the specific framework of the AIPA ruling. When your entire physical hardware supply chain is reliant on global manufacturing and massive cargo ships crossing the Pacific, you cannot accurately project your gross margins if you literally don't know what your import tax rate will be in 6 months.
That is a very real fear.
The refusal to guide on margins isn't them hiding something. It is an honest, albeit frustrating for analysts, admission of the macroeconomic reality we live in today.
That makes a lot of sense. You can't promise Wall Street a 20% margin if a stroke of a pen in Washington could instantly add a 25% tax to every machine you bring into the port of Los Angeles. But if things do get rocky, if the tariffs hit, or if the summer subscriber slump is worse than expected, it is worth noting that they have built an absolute fortress of a balance sheet to weather the storm.
It really is a fortress.
Let's outline the financial armor this company is wearing. They are sitting on $276 million in cash and cash equivalents. They have zero long-term debt, none. And as we mentioned earlier, despite the shrinking revenue, they generated $200.2 million in operating cash flow in 2025. This is an incredibly cash-generative business.
It is a phenomenal balance sheet. In an era where many consumer discretionary companies are drowning in debt service payments due to higher interest rates, having zero debt and $250 million in cash is a massive strategic advantage. And they are aggressively returning that capital to shareholders. They aren't just hoarding it.
They bought back stock, right?
In Q4 alone, they bought back 1.1 million shares of their own stock for $5.6 million. That leaves $41.3 million remaining on their current share repurchase authorization, meaning they have a lot of dry powder to keep buying the stock if the price dips.
And they also reward the people holding the stock. On top of the buybacks, they paid a 10-cent semi-annual dividend in January 2026, which returned roughly $21 million in cash directly to shareholders. They are pulling every single financial lever available to support the equity from a capital allocation standpoint.
Just a quick housekeeping note on the financials before we move on to the broader sentiment. If any of you listening actually dug into the 10K filing and looked at their Q4 tax rate, you might have had a heart attack. It was printed at a bizarre 51%.
Yeah, paying 51% in taxes will usually crush an earnings report. What happened there?
It's nothing structural to worry about. It was just an accounting true-up. A true-up is essentially an end-of-year reconciliation. Because their overall profitability for the year was higher than initially projected, they had to make a lump sum adjustment in Q4 to make the math work. That true-up brought their full-year effective tax rate to 28.9%, which is perfectly in line with corporate expectations.
Okay, good.
So if you see that 51% figure floating around on financial message boards, ignore it. It's just accounting mechanics, not a sudden massive tax burden.
That is a great clarification. But all of this financial data, all of these strategic pivots, lead us to the most important part of our analysis, the investor context. We have to synthesize the sentiment and look at the massive glaring disconnect between what Wall Street analysts are saying and what the actual stock price is doing.
That disconnect is the most fascinating part of the Cricut story right now. Let's start with the tone of the call itself. The CEO's raw candor on this call was striking. He explicitly stated on the record that he was disappointed in the lack of total company sales growth. He repeatedly stressed a need for urgency across the organization.
You don't often hear CEOs of profitable cash-generating companies speak with that level of blunt dissatisfaction. Usually, earnings calls are an exercise in corporate cheerleading, no matter how bad the numbers are.
You don't, and it highlights the core tension here. The CEO knows the transition from hardware to software isn't happening fast enough to offset the decay of the materials business. Now, contrast that internal urgency with the short-term market reaction, the 5% after-hours pop we discussed at the very beginning of the show.
Right, the retail investors bought it.
The retail markets saw a slight earnings beat and bought the stock, but if you look at the structural reality that the institutional analysts are seeing, it is a very different story.
Right, if you aggregate the Wall Street consensus ratings, it averages out to a strong sell. That is incredibly rare for a company with no debt and an 89% software margin. The average 12-month price target from the major banks is sitting around $3.60, which represents significant downside from where it's trading today.
Though there are a few outliers.
Now, to be fair, there are a few optimistic outliers. Some analysts are holding buy ratings with a $5 to target, banking heavily on the AI and DTF rollout. The street is deeply polarized, but heavily skewed bearish.
So what does this all mean for you, the listener, trying to make sense of this? You have to consider the core philosophical tension defining this stock. There are two camps. Camp one believes this company is a classic value trap. A value trap is a stock that looks cheap because it has a low price-to-earnings ratio and a lot of cash, but it's cheap for a reason. Camp one believes Cricut is a mature, declining hardware company that is going to slowly bleed market share to cheap overseas competitors on Amazon until it fades into complete irrelevance.
And then there was Camp 2. Camp 2 believes Cricut is a fundamentally misunderstood subscription software company. They see the 3 million subscribers and the 89% margins, and they believe the company is on the verge of an AI-driven and services-led reacceleration. They believe the direct-to-film service will sever the reliance on hardware and turn them into a high-growth SaaS platform.
And that is the multi-million-dollar question. Who is right? I will say this. The burden of proof is sitting squarely heavily on management's shoulders. The bundle-first strategy and the direct-to-film service absolutely have to work. They cannot just be neat press releases. They have to generate tangible, top-line revenue.
They need actual sales.
They have to prove that these initiatives can reaccelerate overall sales because the market is no longer going to reward them just for cutting costs, buying back shares, and generating cash. They need top-line expansion to justify any sort of multiple expansion for this stock.
Okay, we have covered the fundamentals, we have covered the strategy, and we have covered the existential dread of the white label market. Let's transition to my absolute favorite part of the show. We are formally entering our This Is Not Financial Advice segment.
The best part.
As a very important reminder to everyone listening, these are theoretical, outrageous, but plausible pitches. Think of this scenario like a hungry, aggressive hedge fund analyst pitching a wild, high-conviction idea to their hardened investment committee. We are exploring the outer bounds of what is structurally possible based on the data, not telling you what to buy or sell in your own portfolio. Please, do your own research.
I am ready to pitch the committee. I have been looking at the sum of the parts valuation here, and I have a play. I call this the Trojan horse spinoff trade. This is a bold, highly structural pairs trade. The play is simple on paper, but complex in execution. Go long CRCT and aggressively short the XLY, the broad consumer discretionary ETF we talked about at the top of the show.
Okay, I am the skeptical portfolio manager. Lay out the thesis for me. Why on earth are we going long, meaning we are betting the stock will go up on a company with shrinking top-line revenue, declining active user engagement, and a massive competitive threat from Amazon?
We are going long because the market is mispricing the parts. Look at the balance sheet again. $276 million in cash, zero debt. Now look at the platform side of the business. An 89% gross margin software business generating $84 million a quarter in highly predictable recurring revenue from 3 million loyal subscribers.
Okay.
The problem is that the valuation multiple on the stock is being violently compressed by the hardware business, which we established is a low-margin albatross. The street is looking at the combined entity and valuing the whole thing like a struggling retail hardware vendor.
Okay, I follow the logic. The software is a hidden gem trapped in a hardware prison. But value traps can stay trapped forever. What is the specific catalyst that unlocks the value and makes the stock go up?
The catalyst is the cash pile. That much unencumbered cash sitting on a balance sheet with zero debt is a flashing neon beacon for activist investors. Think about firms like Elliott Management or Carl Icahn's Playbook. The pitch here is that an activist steps in, quietly accumulates a sizable 9% position in the stock, and then forces management's hand publicly.
Oh, a hostile takeover kind of vibe.
The activist looks at the 18% margin hardware business bleeding market share and says, stop the bleeding. Stop manufacturing this hardware entirely. They launch a proxy fight and force the board to spin off or entirely license out the physical hardware manufacturing to a third-party white labeler.
Oh, wow. So you were proposing they just wash their hands of the physical machines entirely. They let someone else build the hardware, take the inventory risk, and deal with the supply chain, while Cricut just collects a licensing fee.
Exactly. And look at what happens to the remaining company. Cricut becomes a pure-play, high-margin design software, content, and AI company. They become a mini Adobe specifically tailored for the massive global crafting demographic. When you strip away the massive capital expenditure required to design hardware, and you remove the immense inventory risk of building physical machines that might sit on a boat during a tariff war, the free cash flow profile of the remaining software business explodes.
And the multiple re-rate.
The market is then forced to completely re-rate the stock. They stop valuing it at a 10x hardware multiple, and they start valuing it at a 25x or 30x SaaS multiple. The stock price triples based purely on financial engineering, not even organic growth.
That is a fascinating scenario. But what about the other half of the trade? Why are we simultaneously shorting the XLY? Why not just buy Cricut and wait for the activist?
The mechanics of shorting the XLY are crucial here to protect the portfolio. By shorting the consumer discretionary ETF betting that the broader sector will go down, you are hedging out the broad macroeconomic beta.
Let's translate that for folks not swimming in hedge fund jargon every day. When you say hedging out the macroeconomic beta, you basically mean we aren't betting on whether the overall economy or the average U.S. consumer is doing well or poorly, right?
Exactly. The XLY is currently plagued by broad systemic issues: demand elasticity, relentless inflation pressure on the consumer's wallet, and promotional retail bloodbaths as stores slash prices to clear inventory. We do not want our trade to rely on predicting the health of the U.S. consumer over the next 12 months. By shorting the index, we isolate our exposure. If the whole market crashes because of inflation, our short position on the XLY makes money, offsetting the losses on Cricut.
So it's a market-neutral bet.
Precisely. We are purely betting on the idiosyncratic alpha, the unique company-specific performance of Cricut undergoing a massive multiple re-rating. We are betting that an activist steps in, forces a hardware spin-off, and unlocks the hidden SaaS company. It is a highly targeted bet on corporate restructuring, completely insulated from whether people are buying cars or refrigerators.
That is a wildly compelling, highly structural pitch. I love the idea of an activist coming in and just cleanly severing the dead weight. And honestly, it perfectly encapsulates the strange, contradictory reality of this company right now. As we wrap up this deep dive into the source material, let's recap the core theme we've uncovered today.
It's been a ride.
We are looking at a literal tale of two companies trapped in one corporate structure. On one hand, you have a thriving, incredibly sticky software platform generating elite, world-class margins. On the other hand, it is shackled to a flailing, increasingly commoditized hardware business that is losing its moat. And caught in the middle, you have a management team racing against the clock to bridge that valuation gap with bundled out-of-the-box experiences, AI workflows, and new print-on-demand services.
It is the ultimate race between digital innovation and physical commoditization. And I want to leave you, the listener, with a final provocative thought to mull over as you watch this sector. If management is truly successful in shifting the business toward monetizing services like direct-to-film, where they are handling the complex printing and fulfilling the physical product, and the user never even has to purchase, plug in, or troubleshoot a cutting machine, does the legacy hardware business even matter in 5 years?
That's a great question.
If the software is intuitive enough, and the AI is good enough to design absolutely anything with a text prompt, maybe the ultimate evolution of this company is leaving the desktop hardware behind entirely and becoming the operating system for personalized creation.
That is exactly the kind of structural, long-term question that will define this stock's performance over the next 24 to 36 months. As always, a final and important reminder, none of this was financial advice. We are analyzing public data, dissecting earnings calls, and exploring theoretical scenarios. Please do your own due diligence and consult a licensed professional before making any moves in the market. We'd absolutely love to hear your take on this. Do you think the bundle strategy will save the hardware? Are you buying into the AI rollout? Or do you agree with the activist spin-off theory? Share your thoughts with us on the Talk Tickers platform or wherever you engage with the show. Until next time, keep your eyes on the SEC filings and your ears to the tape. Stay sharp, everyone.